All right. We'll get everybody in. While we're getting everybody in, I always like to ask Rob, where are you at today?
Where you be?
Yeah.
Where you be? I'm in the Bay Area,
Okay.
and
It
it is
looks
a
so pretty behind you.
spectacular autumn day.
Okay. Do the
Spectacular.
leaves change there? Like, the last time we had this like glorious fall leaves that were falling all around
Ah,
you. Do they change like that in the Bay Area?
not like that. Not
Okay.
like that. And have you already had your 3 days of autumn in Austin, Texas?
No, it still hasn't hit yet.
Oh,
I don't have a single colored leaf in my yard. So yeah.
Mike, where are you?
So I'm in Rochester, New York. So it is fall's in full gear. The leaves are amazing. I live right by Bristol Mountain, and every day I drive by it, I mean, it's spectacular. We're at peak right now.
That's awesome. You'll have to
Yeah.
take a picture and send it over to me.
I will do that, Melissa.
I will be really jealous. Richard, you're right. It is 93 in Austin today. So there is no Yep, it's real. Goodness gracious. Okay, well, we will yeah, Amy says upstate New York is also so beautiful in the fall.
It is.
Yeah, you have to make sure you send us some pictures so that I can be super jealous and maybe just live a little vicariously through you, because it's not really fall in Austin, but like Rob said, but only for a few days. You get this like massive color change and then they're just gone. So,
Yeah.
and it's not like the pretty yellows and reds, it just goes from like green to brown. So, okay. All right. I'm going to be, I'll stop talking about fall for a little bit. If y'all can't tell, I miss it a little and I'm a little jealous, but I'll go ahead and kick us off. Thank you everybody for joining us. I am Melissa Langdale. I am the president and COO of the Mortgage Collaborative, and joined as always by Rob Chrisman. And this week we have a very special guest, Mike Pulver, who is the SVP of Residential Mortgage at GRB Bank. Thanks for joining us, Mike.
Thanks for having me. I'm excited.
And bringing us a little bit of highlights on your fall experience.
Yeah, I will definitely take some photos. We're gonna go on a wine tour this weekend, so I'll send you a little bit of both.
Oh my gosh, that sounds fantastic. I'm also jealous of the wine tour. So now I need to get us back on mortgage, but I could get derailed a couple of ways there. But give us a little bit of an update about GRB Bank. Would love to kind of hear how things are going. I believe you have a podcast of your own that you've done with Joe, right?
Yes. So just well, I'll share that with you. We just wrapped up our podcast about an hour ago, and I'll share with you just in a minute what that was, what it is, and kind of why we do it and what we talk about. But so I'm here in Rochester, New York, and been with GRB for going on 9 years, and we 100%
Genesee Regional Bank.
Genesee Regional Bank, correct, right. We're located in, and I say that, Rob, we actually function like a IMB within a bank. We've got 21 LOs. Most of our business comes from realtors. I'd say 90%. Right now, we're 96% purchase. And this year, we're going to end up probably closing about 350 to 360 million, down from 420 last year. So certainly it's less, but I'm pleased that we've picked up purchase market share, and just a testament to the great team that I have here. So, and now going back to the podcast. So Joe and I started the podcast about a year ago, and really it was something we wanted to do that was fun, but really was directed towards the realtors, and providing them with updates on the market and one of the specific things that we've done that I have found has been really well received is each month, Joe does a great job of basically providing the history of the transactions that we did the preceding 30 days to include by zip code, the average list price, the contract price, the appraised value, with the purpose of that being to let the realtors in real time educate their buyers and sellers on what's going on in each community. And the value that that brings, I mean, you guys have seen where we live, the Rochester, upstate New York market is really, I mean, it is competitive. It's been ranked in the top 5 most competitive markets, really pretty much for the entire year. So it's common, and it still is going on today, that in many of these zip codes, homes are selling for 10 to 20% above the list price. So maybe there's other parts of the country that have softened. We're not seeing that here.
What a great tool for your loan officers to, you know, and for you to just continue to reach out to your real estate market. I love that. That's a really great idea.
Yeah.
Well, you also got your CMB, I understand, in the last year, right?
I did. It was, it's a lot of work. I mean, I'm certainly proud and glad that I, did it, but being a production guy, you really, until you dive into it, you know a little bit about secondary, a little bit about servicing, but until you really dive into it, you really realize how much you don't know.
Yeah.
So,
well, and
I realize how much I don't know every day, Mike. So it's an ongoing situation for me.
Yeah.
Rob and I actually had the kind of pleasure of being at the MBA annual in the last few days. And so, there were a whole bunch of CMBs that were just named there. But I also wanted to kind of make sure, Rob, I could pick your brain a little bit on some of the things that you heard in the economist panel, and then in maybe the cap markets committee, the things that you can share, of course. Would just love to hear kind of the pulse on what you heard there.
Well, I don't know as I necessarily agree with what the MBA's official stance is, and the fact of the matter is well, we can start with that. The economist panel Sunday afternoon that I went to, primarily talking about interest rate projections and volume projections and so forth. And I tend to be a little more pessimistic than Mike and Joel and Marina in terms of what they were talking about for 2024, seeing a pickup. I've been, and they have a lot more analytics than I do. I just get a sense by looking at the weekly applications that it's, doing this, and I don't know what's going to make it, do that. They seem to think that it's going to do that people will get used to this mortgage rate environment, that mortgage rates will actually improve, and treasury rates might stay the same, mind you, and mortgage rates improve depending on supply and demand of mortgage-backed securities. But they see an uptick in volume next year. They see rates coming back down, mortgage rates, I should say, and mortgage rates very well may come back down somewhat. And just as a reminder, and I know we've talked about this on the show before, but that's the primary reason why investors are very hesitant about paying, 102 or 103 for, an 8% or an 8.25% or even an 8.5% loan right now, because they don't want to pay a premium and have the loan pay off 3 months down the road or 6 months down the road. And that was some of the noise, some of the chatter, I should say, in an informal session, or I get together with this mortgage mastermind group. I think that's the name, Mastermind Breakfast. And in fact, like Allison Johnson with Success was in there as well. And we heard from an expert on credit, talking about the credit changes coming up. But it's just kind of a roundtable about situations and things that are going on in the industry that everybody's seeing. And one of those is the fear of EPOs, early payoffs, and the EPO penalties that might be assessed lenders should rates drift back down or jump down. Suddenly you're refinancing people that you financed 3 months ago or 5 months ago, and the investors aren't big fans of that, of course. And so the early payoff penalties may rear their head at some point. But right now, the general rate environment, given what's going on, it's almost as if the bond market is doing the Federal Reserve's work for it. The Federal Reserve doesn't have to raise rates if rates have already gone up. If we are at 5% on a 10-year and 8% for 30-year mortgages, that slows the economy down maybe enough without the Fed raising overnight interest rates yet again. So kind of the talk out there is we could chop around here for a while, maybe see a rate decline in 2024. I think rates will come down in 2024, but the volume that's out there, if you don't like your volume now, that's not a good sign, because there's not going to be a huge pickup in volume, really from an industry perspective, not for a while at least. And so what you're dealing with are institutions like, Genesee Regional Bank and other lenders trying to grab market share away from their competitors, and trying to get a bigger piece of the pie in a shrinking pie environment. And that's not always easy to do. And so yesterday, for example, I sat in on a panel, not in Philadelphia, but here in Northern California, where I was moderating a panel of top producers with an pretty good sized audience for a Thursday at 1:00. I'm thinking, gosh, there's a lot of lenders and senior managers in here, but then you realize they're not doing much. So why not come to this? But talking about some of the things that they are doing and some of the changes they've made to their business models in terms of trying to go out and get business. And it's just not a matter of sending a pumpkin pie recipe out once a year to your previous clients and schmoozing with the realtors and going to the open houses and bringing cookies. I mean, these producers are really working hard to get the business and contacting, going to remodeling shows, trying to talk to contractors, going to the local community college to teach classes in mortgages, to try to think, okay, these are tenants now, but they may be homeowners and I want to get my name out there. They're calling on divorce attorneys. They're calling on, they're just trying to throw things out there just to see what sticks. So it's a matter of, when you talk about the overall economic environment and the lending environment, the lenders, they can't control interest rates, but they can control how they react to them and their business models and how they adjust. And that's what I'm seeing out there. And that was echoed in Philadelphia, that lenders are doing things, to cut costs. I mentioned it in my opening paragraph today. For example, charging borrowers for credit reports rather than just having them pay at the end of the process, having them pay up front, because lenders are tired of paying for credit reports of loans that don't close with them.
Yeah.
So, there's a business model shift going on out there.
Yeah. Well, Mike, obviously you have started to get creative with your team as well, trying to reach the realtor market with your podcast and some of those things. What are some things that you're seeing in your market? What are some of the things that your kind of successful LOs are bringing to you to help them to continue to grow their business and continue to reach those realtors to keep their volume up?
Yeah. So, obviously, it is a challenging time, but, I think, one of the things that I'm a Todd Duncan disciple, and, met him when I was 25 years old, and I'm actually 60 now. So, and I have always followed what he does. And I think what we're doing is really ensuring, that we're having kind of impactful discussions with our agents that we work with. And right now, because we're going into the end of the year, having those planning discussions with your realtors about, what are their goals, their objectives going into the new year, and how can we become part of your team to be successful? So I think it's really getting back to those basics. But what we're doing, and we just actually had a great sales meeting yesterday where there's some really cool things that are going on in New York, from a product perspective that are really aimed at trying to address the affordability issues that exist. So one, we're part of the Federal Home Loan Bank of New York. We are, proud to say the number one, what we call home buyer dream lender in the state. So what that is that the Federal Home Loan Bank last year, for borrowers that qualified from an income perspective, the first-time home buyers are getting a $10,000 forgivable grant. They just announced that they're increasing that from 10 to 20,000. So for next year, and that's going to start in January 8th. So we're beginning to work with realtors to partner with them to say, all right, there is a finite amount of funds. Let's make certain that we get your folks pre-qualified for this program, based on what those income parameters will be. And so that's creating a lot of buzz. Sunny Mae, which is, the New York State bond program, just announced a $30,000 grant program. They're putting $10 million into that program. So we're really out there educating the agents on, okay, how can we take advantage of these programs and get people prepared for it? Because the money's going to go fast, but it's, from our perspective, it kind of gave our LOs a shot in the arm, if you will, too, because we got something to talk about, something exciting that's going to help home buyers. And the last thing I'll share is that we are a preferred lender with the area's largest employer, which happens to be hospital and a university, and they have, between all the different they have about 80,000 employees. So there's discounts that we provide those employees. They have another grant program. So we're taking all of this and saying, hey, listen, let's make certain that we're educating the realtors on what's going on, and in lieu of just getting them fixated on, hey, rates are now 8%, which they are, but there's a lot of other tools out there. And we want to be that lender that is informing and providing them some real value so that they can help more buyers. And granted, it is a tough environment right now, but I just try to tell our LOs, what, your career, it's not a sprint, it's a marathon, and it's some tough sledding right now, but you're just going to have to work harder.
Hey, Mike, where does the money, 20 grand here, 30 grand there, where does that money come from?
That's a great question. So the Federal Home Loan Bank of New York, the way that they fund that program is through profits that the Federal Home Loan Bank earns. And what's interesting, in a year like we just had, banks are having to use the Federal Reserve to fund their loans because deposits have gotten so expensive. So we're borrowing more money from the Fed. And when banks do that, the Fed makes more money because those advances are up. In lieu of when rates were zero, you had a lot of deposits. We could fund our loans internally. We can't do that. So their profits are actually up. So there's more money going into that program. Sunny Mae actually, they actually issue bonds, and that's where the money comes from, the state. So those programs, again, there's a lot of work to them, but the value, when you think about, and what's really cool, just one last thing I'll say is that those two programs can be combined. I mean, you could get a $30,000, grant from Sunny May and a 20,000. I mean, so you think about the firepower that, it's pretty cool.
That makes a big difference for sure.
Yeah.
That's interesting.
Yeah.
Um,
The one last thing too, Melissa, not to occupy the podcast, but one of the things, and this is something that I think, Rob, with the role that you play in the industry, and one of the things that we're doing in our backyard right now is about maybe a little bit less than a year ago, the local president of the realtor group here in town started a task force. And the purpose of this task force was to really get the right people in the room to really begin, how are we going to address this inventory shortage in our backyard? So this task force includes lenders, realtors, builders, politicians, people that are on town planning boards, to really talk about, okay, how did we get here? Let's first of all, how did we, get in this place to where the inventory shortages are so extreme? And then once we figure out how we got here, what are we going to do about it? And so we're trying to incubate this in our backyard. And just a couple of things that have come out of this. There's still a lot of work to be done, but one is, the way that zoning has been done the past 10 years has been at kind of the heartbeat of the problem. So we've been working on how do we approach these planning boards that are, say, for instance, it's saying, hey, we only want you to build a home with a minimum of 1 acre. Now we're, needing to change that. So I think there's a lot of momentum going on within that. And I think that each community needs to get together to say, this problem's not going to get resolved on its own.
Yeah.
It's going to require a concerted effort. It's going to require some political will, to get this done. So I'll certainly share with you guys what we're doing here and how it's working, but that's something that I'm pretty passionate about and want to see what we can do to make a difference.
I think that's great. Oh, Rob, we lost your sound.
I muted the sound because it's a little breezy here, but Melissa, I think that TMC should set up a task force to do something, or at least a blue ribbon committee to try to do something.
It was like you threw me this giant softball. So we actually are doing something a little different with our 12 days conference. So for those of you who don't know, we have a virtual conference that we do in December called the 12 Days of TMC. And we're changing things up a little bit, and we are doing some solution sprints where we're going to put people into working groups that are going to solve industry problems. And in fact, inventory and affordability are two of them. So Mike, I might ask you if you can help us with one of those.
Sure.
You have to answer me on here, but that is something that we are starting to work on together. So really excited about what we might come up with and some of the solutions that may come out of it. So would be happy to share it with everybody here.
Nice.
Yeah. So we have, I have a couple of things I want to pick on with or pull on, I guess, with Mike. Your focus on kind of these products and programs and how they're kind of helping give your loan officers some extra tools in the marketplace. You've got just recently, gosh, within the last maybe week or so, I was reading a statistic that kind of was trending kind of market share by lender type, and read some really interesting facts about how kind of small to mid-sized lenders are actually gaining market share through all of this. And so I'm really curious your thoughts on what might be driving it. If it's things like that you're doing that are just really getting active in your local market. But is there are there other things you're doing that you feel like might be driving that as a whole?
Sure. I mean, we're fortunate here in upstate New York. I mean, it is a very conservative community, and they're, to be candid, not really receptive to outsiders, if you will. And I think that there is this comfort that comes from, a local bank, say, like ours. I mean, everything is done under one roof, and we have 21 LOs. We have a total team of 57. We're all here. So someone can walk in and they can talk to me, processor, the underwriter, the closer. I mean, we're all here, and we have a track record of getting loans closed on time all the time. And when transactions are few and far between, realtors don't really like to take chances. They want a sure thing. They want to work with someone that they have experience with. And so we really kind of, build that up, and we really kind of share what our track record is and reinforce that. But I think the other, part of it is that from a visibility perspective, we are very involved in the community. And I think, what we try to do is not only, give back, but we publish where we're at. We take a lot of photos and videos, and we put the word out there. So I think we're doing a lot of the basics really, really well. But I think we're also, going back to this this podcast that I mentioned. I think we're providing some real useful value outside of just a product and a rate, some market intelligence that I find our partners, learn a lot from and value that as well. So I think, going back to the question, I think smaller lenders, I think, again, no disrespect towards larger lenders, but, I think, we don't have a big servicing book. We got to be sharp. We got to earn every deal. And I just try to share with our team in the most constructive way that, we always have to be reminded that there's a lot of other lenders that people can get their mortgage from. And if we just do a really great job, as corny as this sounds, that one loan can lead to 5. But if we don't do a great job, that might be the last one that we get. So I think there's a real effort around just blowing away every client and every realtor on every deal. So that's what we're doing. And I think, as long as lenders do that, even in a really tight environment like we're in now, it's going to be hard for those referral sources to go someplace else.
Yeah. All right. We have time for maybe one more question. Rob, do you want to take the last one?
No.
No.
I'm being belittled in the chat room here. I'm still trying to recover from that. Mike, I want to ask you, I'll be blunt here.
Yeah.
That's my role in this whole show, right?
Go for it. Do it.
Yeah. Rob doesn't pussyfoot around some of these issues, but there were some noticeable people that did not come to Philadelphia.
Mm-hmm.
There were some people, granted attendance was down, but some of the old standbys who have been in the industry for a while, I think, are really questioning their role. If we're in an 8% environment for another 6 months, what's that going to do to my business? Do I want to go through this rodeo again? That kind of thing.
Right.
Do you have the sense? You said you had 21 loan officers?
Correct.
Do you have, I don't, without revealing any trade secrets, but have you seen a lot of turnover there? Is the old are the older crew sitting there thinking, I don't want to, I'm tired, or is everybody, or all your loan officers in their 20s and 30s and they're young, eager beaver types? What's going on? What's going through the head of the typical Genesee Regional Bank originator right now? If you had to put your finger on it, if you had to guess.
I would just say it really depends, because Rob, we have a cross section, we have folks that, that are my age, and then we have others, that we've hired in the past, few years that are 25, 26 years old. One of our top LOs, is 27 years old. He's been in the business for 2 years. He's going to do 160 purchase transactions and close 25 million, so, but he's the, does all the right things. But I think, from a retention perspective, Rob, to be, transparent with you, we haven't had any turnover until, really the past month. We lost, 2 of our top LOs to a very large national IMB that, really made them, a significant offer to come on board. I wish them the best, and they were great while they were here. But that being said, the balance of our LOs that are here, although they're nervous about the environment, that we're in, but really for the most part, most of them are going to end up doing between 70 to 90% of what they did in 2022 in this environment, and a couple are going to do about the same. So I think there is this nervousness about, to your point, what's the next 6 months look like if rates stay at 8. So I think they're apprehensive, but you know what, at least for our group, I'm just trying to, remind them that right now you're trying to survive this environment. We do think that rates are going to come down at some point, and that the market will gradually, improve. I'm not trying to sugarcoat it, because I do think it's going to be tough. But if they're making a living and doing well, that's where, I'm just trying to be as realistic as I can with folks, but to try to sprinkle in a little optimism, around it. So I don't know if that answers the question, Rob, but it's just trying to, be real, but also being real about the fact that, I'll end with this. I said, I always use a lot of sports analogies in our sales meeting. I say, like we're like the, team that, we're down 8 in a basketball game with 3 minutes to go. And when that's the case, you don't play zone. You play man-to-man. You got to do a full court press, and you got to dive for balls. And that's the world that we're in. If you're willing to do that, you're probably going to be okay. If you're not willing to do that, you're going to lose deals to someone that is willing to do it. And I think that's just the world that we're in.
That is an incredible analogy. Oh my gosh. And Rob just kind of stole the show for a second.
Oh my goodness.
Well, when Mike goes down that path, I have to bring in female representation to say man on man or woman on woman, right?
Right,
So,
right.
here she is,
Aw,
Cosette.
she's precious. Hello, Cosette.
So Mike, I agree with you.
Oh, bless.
No child was harmed in this filming, by
Yeah, no.
the way. It is a tough environment, and it's really cool that your top LO is 27 years old, because a lot of those folks, they don't they're not the ones sitting in the lobby of the hotel at the conference saying, "Oh, remember Countrywide, G fees in 2002 or what?" And this is their environment. They don't look back and think, "Oh, I wish we didn't have Dodd-Frank. I wish we didn't have the CFPB." I mean, they got into this industry with Dodd-Frank and with the CFPB and with the regulations that we have now, and now with the interest rates we have. And they're the ones who I think are looking at new ways of getting business, and they're eager to help their customers. They're not sitting there at this, the steel desk in the corner with the potted palm, with the cigarette burning in the ashtray on the corner of the desk. I mean, they're out there beating the bushes and they're trying new things. So that's good.
I don't know that that's a realistic representation. All right. I'm going to wrap us up because I feel like we're going down a road. But I agree with both of you guys, being in the business in 2008 and being in a sales role in that environment, even when the market shifts, I'll say that even when the market shifts, you shift your activities, you shift your, kind of focus. And it's fun to see people that are still able to grow and maintain their volume and all of this just based on their ability to kind of continue to pivot and grind. And so
there are people out there. I mean, there are many originators when I travel around, visit with groups. I mean, there are originators who are having a better year, for example, than they did last year. Because they're putting in the time and the effort and they're not afraid to do so. It's tough. It's a tough job. It's a tough job.
Yeah. All righty. I am going to wrap us up. Before I wrap us up, I want to say if you guys found value to this and would like to subscribe to our YouTube channel, you can catch all of our episodes there. Mike, thank you so much for joining us. Rob, thanks for joining me every week and putting up with my antics every now and again too. And thanks everybody for joining us. Happy Friday, and we will see you again next week.
See you guys. Thanks. See you guys. Bye.